What we just witnessed in the precious metals market looks, at first glance, like a collapse. Prices fell hard and fast, and the speed of the move alone was enough to convince most people that something fundamental broke. When markets erase trillions in value in a matter of hours, the natural reaction is fear. And fear always reaches for the simplest explanation. The charts look ugly, the headlines are dramatic, and the conclusion seems obvious to anyone watching price alone. Weakness. Failure. The end of a run that went too far. But markets don't tell the truth through price in isolation. They tell the truth through contradictions. And this move was full of them. Because while paper prices were being crushed, nothing meaningful changed in the real-world supply of gold or silver. No mines shut down. No industrial demand vanished. No sudden flood of metal appeared out of nowhere. There was no fundamental shock that justified a violent repricing of this magnitude. Yet the market behaved as if demand evaporated overnight. That disconnect is not normal, and it's the first signal that this wasn't a natural correction driven by fundamentals. At the same time, paper prices were collapsing. Physical demand was doing the opposite. Contracts tied to actual metal delivery were being called in aggressively, and this surge happened before the price smash, not after it. That detail matters more than most people realize. In a genuine breakdown, physical buyers step away as prices fall. Premiums compress. Sellers panic. The market clears lower because nobody wants to take delivery. That is how weakness expresses itself in the real world. That didn't happen here. Instead, buyers kept showing up. Physical premiums stayed elevated, even after the crash. In some markets, people were still willing to pay dramatically more for real metal than what paper contracts were implying. That means the physical market was not validating the paper price at all. It was rejecting it. When paper and physical diverge like this, it signals stress inside the system that connects them. Futures markets rely on leverage, confidence, and the assumption that most participants will settle in cash rather than demand delivery. When too many participants start leaning toward delivery at the same time, the system becomes fragile. Liquidity alone can't solve that. The fastest way to regain control is to force liquidation, break confidence, and shake out participants who cannot withstand volatility. Violent price moves are tools in that process. A paper price smash doesn't create metal, it doesn't increase supply, it doesn't reduce real demand. What it does is trigger margin calls, stop losses, and force selling. It resets positioning. It buys time, and time is exactly what a stress system needs when underlying imbalances haven't been resolved. This is why the speed of the move matters so much. Healthy markets don't need to be forced lower. They drift lower as buyers disappear. Force is applied when control is slipping, not when confidence is high. The more abrupt and exaggerated the move, the more it suggests desperation rather than strength. Now, none of this means the risk isn't real. Moves like this cause real damage, especially to traders operating with leverage or tight timeframes. Technical damage matters in the short run. Liquidity events don't care about long-term theses, and markets can remain unstable longer than most people can stay solvent. If you were positioned aggressively, this environment is unforgiving, and pretending otherwise would be dishonest. But short-term pain does not equal long-term invalidation. This type of move fits a very old pattern in markets during periods of rising macro uncertainty. When stress increases, everything gets sold first as participants rush for liquidity. Precious metals are not immune to that initial phase. They often get hit early, not because they lose their role, but because they are liquid. Later, once forced selling exhausts itself and policy responses emerge, those same assets often rebound violently as capital seeks stability again. What makes this moment different is the scale of the disconnect between what paper markets are saying and what physical buyers are doing. When people are paying large premiums for real metal while futures prices are collapsing, it tells you that the reference price is no longer trusted. The screen price stops functioning as a clearing mechanism and becomes a stress signal instead. That's not the behavior of a broken bull market. That's the behavior of a system under pressure. Weak markets don't need dramatic intervention. Strong fundamentals don't collapse quietly. When a market has to be shocked into submission, it usually means something beneath the surface is tightening, not loosening. And when that tension isn't resolved by real supply changes, it doesn't disappear. It builds. Right now, what we're watching is not resolution. It's the clearing phase. The uncomfortable, violent part designed to discourage participation, flush leverage, and restore short-term control. That phase always feels chaotic, and it always convinces most people that the move is over before the real repricing begins. The key is understanding which game you're playing. If your horizon is short, this environment is dangerous. If your horizon is longer, volatility becomes information instead of fear. And the information here is clear if you know where to look. Physical demand didn't break. Supply didn't improve. Premiums didn't collapse. Only paper confidence did. That distinction is everything. What happens next is where most people lose the thread, because once the shock phase passes, the narrative usually flips too quickly in the other direction. People either assume the danger is over because price stopped falling, or they assume the market is broken forever because it didn't bounce immediately. Both reactions miss what actually matters, which is how stress resolves inside systems that are built on leverage and confidence, rather than physical constraints. After a forced liquidation event, the first thing that changes is positioning, not fundamentals. The weak hands are gone. The over-leveraged positions are cleared. The participants who remain are either underexposed or structurally aligned with the underlying reality of the market. That shift alone alters how price behaves. even if nothing else changes. Volatility often compresses briefly, not because risk vanished, but because there is no longer enough leverage left to amplify every move. At the same time, the physical side keeps doing what it was already doing. Industrial demand doesn't pause because a chart printed a red candle. Fabricators still need metal. Energy transition infrastructure doesn't suddenly stop consuming inputs. Coins and bars don't become less scarce because futures contracts changed hands electronically. These forces operate on timelines measured in months and years, not hours and days. This is why the physical market is such an important anchor during moments like this. When premiums remain elevated after a crash, it tells you sellers are not flooding the market. It tells you buyers are still competing for supply. In real breakdowns, premiums collapse because sellers panic and demand disappears. Here, the opposite dynamic is still present beneath the surface. That doesn't guarantee immediate upside, but it does create a floor that paper markets eventually have to respect. The broader macro backdrop matters here as well. Liquidity events rarely happen in isolation. They cluster around uncertainty, policy risk, and tightening financial conditions. When confidence wobbles, capital doesn't immediately run towards safety, it runs toward cash. That's why even assets that benefit later from instability often get sold first. This initial phase is mechanical, not emotional. It's driven by margin, collateral requirements, and balance sheet stress. But cash is not an end state. It's a temporary refuge. Once the forced selling phase exhausts itself, capital starts looking for assets that can't be diluted, frozen, or restructured by policy responses. Historically, that's when precious metals begin to reassert themselves. Not quietly, and not politely. The moves that follow are often sharp, uneven, and uncomfortable, especially for anyone who exited during the panic and waits for perfect confirmation to re-enter. Another mistake people make at this stage is assuming that because something fell hard, it must now rise smoothly. Markets don't work that way. Rebounds after violent sell-offs are rarely linear. They're volatile, frustrating, and full of false starts, price chops, sentiment stays fragile. Headlines remain negative long after conditions start improving. That's how markets ensure participation stays low during the early stages of recovery. This is also where paper and physical can remain disconnected for longer than expected. The futures market may hesitate, grind, or retest lows, while physical tightness continues quietly in the background. That divergence doesn't resolve on a schedule. It resolves when stress reaches a point where the paper price can no longer clear supply without rising to meet physical reality. That moment is impossible to time precisely, which is why trying to trade it with leverage is so dangerous. The long-term thesis can be correct and still destroy short-term positioning. This is not a contradiction. It's a feature of volatile markets. What matters most is understanding causality. The crash didn't happen because demand collapsed. It happened because leverage was flushed. The physical market didn't panic because it wasn't overextended. The paper market did because it was. That asymmetry explains nearly everything about the move. From a structural perspective, nothing meaningful was resolved by the sell-off. No new supply was created. No long-term demand was eliminated. No systemic risk was removed. All that changed was who is still standing and how much leverage remains in the system. That means the underlying tension is still there, just temporarily suppressed. Markets can suppress reality for a while, but they can't erase it. This is why emotionally, these moments feel so confusing. The price action screams danger, but the fundamentals whisper persistence. Most people choose to listen to the louder signal, even when it's the less reliable one. By the time confidence returns, price is usually already moved. None of this is a call to blind optimism. Risk remains. Volatility remains. Policy mistakes, liquidity shocks, and macro surprises can always push prices lower in the short term. Anyone pretending otherwise is selling comfort, not analysis. But there is a difference between acknowledging risk and misunderstanding cause. What we saw was not the market rejecting precious metals. It was the market revealing stress in the structure that prices them. That distinction is subtle, but it's everything. When history looks back on moves like this, they're rarely remembered as endings. They're remembered as inflection points that only made sense after the fact. In the moment, they feel chaotic and irrational. Later, they look inevitable. The key is not predicting the exact next move. The key is understanding what kind of move just happened. This was not distribution. It was not capitulation by physical holders. It was a forced reset inside a leveraged paper system operating under growing macro strain. And systems that reset this violently rarely settle quietly afterward. They either unravel further or they snap back hard once pressure shifts. The physical market is already telling you which outcome it's preparing for. The paper market just hasn't caught up yet.